Welcome to Invest Well, Be Well, a podcast for wiser investing and stronger living. I'm Rusty Vanneman, longtime investment professional, and I'm joined each week by my co-host, Robin Murray.
Thanks, Rusty. I'm a storyteller and journalist, and I am so excited to explore the ideas, insights, and people shaping the intersection of performance and purpose.
This podcast is for thoughtful investors and driven professionals who want to grow in their portfolios and in their personal lives.
We'll talk long-term investing, behavioral finance, personal development, and what it takes to live and work with intention.
So let's get started. Let's invest well and be well together.
This podcast is brought to you by Main Management, LLC. Since 2002, Main has been recognized as an ETF strategist that combines an institutional process with the personalized service of a boutique firm. Well, our guest today is Darol Ryan. He is a managing partner at Main Management. Somebody you're familiar with there, Rusty. Yeah, we had a great interview. It was good to hear from him.
Yeah. Well, Main Management, of course, is a sponsor of our podcast, but we are definitely excited to welcome Darol. Darol is one of those guys you instantly notice. He's high energy, he's business savvy, and he flat out gets things done. Something else I like about him, his glass is always at least half full, and he brings this contagious optimism that just makes him a lot of fun to be around. And professionally, he's the real deal, as he's built an impressive career in investment management. He's run derivative businesses for major Wall Street firms in New York, Europe, and Asia. And now he leads the institutional advisor business at Main Management. But beyond the resume, Darol is passionate about culture, wise long-term investing, and helping investors think differently about strategies such as option overlay alternative income strategies that we talk about in this conversation.
That's right. He had some interesting stuff to say about that, those kind of strategies, and sort of what to look for. You know, they don't make sense in all cases, but it can be a really great addition to your portfolio if you have, just take the right look at it. We also talked about, the things that he depends on in his sort of routine to recharge, stay grounded. He just had a lot of great stuff to leave our listeners with.
Right on. I mean, we definitely really riffed on the alternative income / hedge equity space because it's so hot in the industry right now. The flows are just really incredible. And I thought it'd be really important just to kind of talk about that a little bit. I thought it'd be useful for many investors. And as you said, he's a high energy guy, and we wanted to know how he did it.
Yep. All right, well, let's listen. Well, Darol, it's so good to see you. Welcome to Invest Well, Be Well.
Thank you. Thank you for having me.
Darol, this should be a lot of fun, but let's get the fun started. And the very first question, as you know, is a walk-up song. We need to set the tone and the energy for this interview.
Rusty, we're doing a big conference out here in a month in San Francisco for our top advisors. Obviously, you're going to be out here as well. And it's going to be the same one I'm using for that, which is Don't Stop Believing by Journey.
Nice.
I don't know that song. Can you sing a little bit for us?
Maybe at the conference I will.
All right. I just heard that as a promise. Awesome. That conference is going to even get better. It's already awesome. Now it's going to get better.
That's great. All right. Well, Darol, we want to talk a little bit about you. So you have worked at some of the biggest names on Wall Street, and now you're at Main Management. When it comes to investment management firms, why do you think culture is so important?
It's a great question. Culture is very important. One of the larger places I worked at, Robin and Rusty, was Morgan Stanley Derivatives Desk in New York. Obviously, that's a pretty big organization. They were able to get culture down pretty well. So I think size is kind of a less of an inhibitor than some people think. And let me step back for a second. So I started trading options when I was 15 years old. So derivatives are in my blood. And it kind of trading derivatives kind of translates on how I think about running businesses and teams. I've always looked at sort of payoffs, risk reward. And when you do that, it always requires you to sort of think strategically 6, 12 months out and even longer. And just like with derivatives and just like in the market, you have to think about where the puck is going. So you have to be making decisions now, and particularly about assembling the right team that can align with your long-term goals. So we hire the best people, no micromanaging. We empower people to chase big goals. And then you have to create a team environment. So, no sharp elbows, I like to say here. And then eventually, it's really important that you start bringing people into the partnership. And as you know, Rusty, you've mentioned this before, over half the people at Main own equity in the firm. another thing that's interesting is that 15% of our assets are actually partner money. So we're invested right alongside of our clients. And I think both of those things, bringing people into the partnership and having skin in the game on the investment side, I think it creates a better outcome for clients. And I think they really appreciate it. So yes, culture is important, but you got to put some real meat on it, I think, and actually bring people into the partnership.
Yeah, right on. So I have, over the last several decades, managed various due diligence teams. And some of those qualities you just mentioned are some of the very tip-top qualities to look for in good investment firms. Eating your own cooking, spreading out equity ownership among employees, that really translates into good performance. So let's talk about wise long-term investing. And in your view, what are the key principles of wise long-term investing?
Yeah, so I guess the one key phrase is time in the market, right? So a lot of people get shaken out at the lows, or they get sucked in at the highs, et cetera. I always like sort of when the market goes down because I'm always a buyer. That's kind of the mean reversion in me. So time in the market, you've got to stay invested. But I also think, one of the things, Rusty, we've talked about this offline, is kind of a diversity in investments is important to me. So I own a range of different asset classes, private equity, some venture, crypto. And in the public area, where most of my money is personally, I'm very diversified as well, right? I own strategies like the 4 we have here, core U.S. equity, some buy right is kind of my yield replacement for some fixed income. I own some high octane growth in the thematic, and I own some international. So you want to diversify not only the asset class, but then in equities, kind of what you own. I'll say 2 other things about that question. I overall think that ETFs are a really elegant way to invest, right? Diversification and tax efficiency. Here at Maine, we're in the good old Republic of California, so we think about taxes a lot. We're very tax aware, and taxes can really eat into your long-term returns. So use things out there that can be tax aware. 529 plans, probably the best. HSAs, IRAs. So it's not just about diversification of investments, but it's also how you implement those. And so, my recommendation at the end of that is talk to an advisor, talk to somebody, that is well-versed in the investing space. And if you don't have one, I'm happy to refer you one.
I bet you know a couple. Hey, I want to follow up on one of your comments. So you talked about one of the big challenges for investors is that they just get shaken out of the market sometimes. They get scared. There's a lot of noise. How do you keep investors focused on the big picture rather than all those distractions?
Yep. So this is kind of a larger topic, almost like on the be well side, distractions. So distractions are kind of a very important topic for me. As I've gotten older, I've kind of learned to take a lot of that noise out of my life. I focus on 2 things, work and my family/friends. I don't have a lot of room for anything else. If I want to be performing at the highest level on those 2 things, I just don't have the bandwidth or a lot of the distractions and noise. Skip Schweiss, who you recently had on your podcast, he said it perfectly. Pick your battles. So, for example, when you have inconsequential things, daily decisions that are repeatable, like what are you wearing today, what do you have for breakfast, etc., I try to set that and leave it so that I can really focus in on what's important. One of the things I do, and this could be controversial, is I overpay and I hire and overpay for the best CPA. I have a concierge doctor, right? I probably overpay, but those are very big decisions, right? Taxes and health are very important topics, but I kind of outsource those things. I lean on trusted advisors, and it's the same thing with investors. They should have a financial advisor to help them so they can focus on what's important to them. And so you get away from the distraction. You get away from selling at the bottom in the market, et cetera. You want to bring people into your life that can help you make those decisions. Even if you got to pay up for it, you'll have better longer-term outcomes.
Yeah. Well, let's talk about one of the more popular investment strategies this year and in recent years, alternative income funds, particularly those using option overlays. How do these fit into wise long-term investment plans, whether for capital appreciation or for generating income distributions?
Great question. Yeah, this has been the hot spot in the last couple of years. We actually started our buy right over 21 years ago. So we've been doing it for quite a while. So one of the things people need to realize, the long-term return of U.S. stocks since day one is about 9.5%. 9.5% is the long-term return of stocks. Now, obviously, in the last decade, we've enjoyed a little bit higher, numbers in a big bull market. But for many of these alternative income funds, in particular ours, the buy right, we are targeting that type of return, sort of high single digits, right? But in the strategies, in these hedged equity strategies, in general, they're trying to go lower beta, lower drawdowns than that stock market. So your returns are a lot smoother. For many investors, this lower vol feature is kind of attractive, right? And then you get the kicker with the income. So we've been running ours, like I said, for about 20 years. And this space gained a lot of popularity post-COVID when interest rates, when they got to zero, people were looking for yield. So personally, I think they sort of sit between equities and fixed income for your average investor. As I said before, I don't know a lot of fixed income. I kind of use this as my replacement. But I think it's a very good strategy in almost every person's asset allocation. It's just another tool for advisors and investors to have at their disposal.
This episode of Invest Well, Be Well is brought to you by Main Management LLC, a pioneer in actively managed ETFs since 2002. Main Management starts with a clear fiduciary focus, delivering the transparency and personal attention you'd expect from a boutique firm. They provide financial advisors with solutions, not products. Main also believes investors should keep more of what they earn, emphasizing net of fee after-tax performance to help clients retain more of their returns. I've known Main Management for years. I've met thousands of managers over the course of my career, and one quality I really value: they invest alongside their clients. They eat their own cooking. Over 10% of the assets they manage are their own partner assets, and more than half of the firm are partners themselves. That says a lot. To learn more about Main strategies, including buy right hedged equity, U.S. sector rotation, thematic innovation, and all asset models, please visit their website at mainmgt.com. So Main Management, of course, has a full suite of investment strategies and solutions that do what they say they do. But I want to stay on the topic that Robin brought up. And again, that's this all-income hedge equity space. And, many investors are not initially attracted to option overlay strategies. And I think there's a couple different concerns that people have. And I want to address some of those misconceptions one by one. So first of all, a lot of people, when they hear the word options, they think high risk. Are they too high risk?
Depends on what you're doing, right? And there's some of them out there that have they're selling puts, or they're buying puts, or we got to keep it simple. We're involved in our favorite sectors, and we sell covered calls against them. So it's actually less risk than just owning the outright ETF. So it depends on which options you're talking about. But if you keep it simple and you do old-fashioned overwriting, it's less risk.
And that does bear out in the numbers. The second question I have is, a lot of people hear options and they think it's just way too complicated. And in turn, you need an army to manage these strategies. How would you rebut that?
So a lot of these strategies, you've got to be careful and look at what's under the hood. So a lot of them will say, like, we've got OTC derivatives or structured products or things you're not going to be able to explain to the typical investor, right? Some of them have got these schemes where they're like timing features or buffers or things that tie up your capital for a while. You want to keep it simple. If options are kind of a scary word for people, keep it simple. Do overwriting, covered call overwriting. I even think, Rusty, to be honest with you, like the put side of it's really tough. There's a lot of people out there that are trying to buy puts. They're trying to time the market when the market's going to correct. The reality is it's hard to execute on that. Nobody typically sells the puts in the end of the day, so they don't take advantage of that move. So in this strategy, I think you just want to keep it fairly simple. Oh, and another thing I'll say is that, there's a lot of these strategies out there that are sort of advertising very, very high yield levels, right? If somebody's telling you they're getting 15, 16% yield every year, it's probably too high to be true. It's too good to be true. And so, as we know, a lot of that is return of capital, right? And so that's another thing that you got to be careful of. If somebody's telling you they're giving you 18% yield, it's probably something's not right. And a lot of that's return of your capital.
Yeah. Well, I have two comments before I have two more questions to follow up on these. So one, again, when it comes to the experience, and again, this is my due diligence hat. When it comes to Maine, Again, you have the GIPS track record that goes back over 2 decades, and you have tons of experience on the staff that have been managing these types of strategies. And it's the same people who have compiled that 20-year track record. So I think that's really interesting. And I also think as a due diligence person, one thing I've noticed when I kind of compare and contrast different alternative income funds / hedged equity is they're so different. And so you really have to know what they're trying to accomplish in a portfolio. So, okay, next question. So another question a lot of people get, what I hear a lot is these type of strategies are just too expensive. How would you answer that?
So some of them are more expensive than just buying your average index fund, et cetera. But I think they provide enough, in 2022, we're actually up on the year. They provide enough buffer on the downside, right? With the better beta. If you can get something that's a 0.35 beta to the S&P and low drawdowns, I think it's worth paying up for. And we're not talking significance, a premium, but you definitely pay higher for these products than most. But around a 1% or lower is kind of what you're traditionally going to be paying.
So one more question I have is, option strategies do not sound tax efficient. Are they tax inefficient? How would you answer that?
So I will say on the yield, you are going to be paying taxes. I think they're better than just outright owning the ag, for example. But on the 6% yield or whatever your yield is, assume you're going to be paying just like qualified dividends. So you assume you are going to be paying 6%, taxes on that 6%. Obviously, if there's any way that people can return some of the capital, then you won't be paying taxes on that. But clearly, it's not as tax aware as just having that money work for you.
Gotcha.
All right. So if an alternative income fund does make sense for an investor in a long-term portfolio, what should they look for in these type of strategies or funds?
Yeah. So I'll go back to just transparency. At our firm, the culture is like transparency. Transparency is very, very important. The same with the funds. If you can't look underneath the surface and tell what you own, if it says it's OTC or if it says it's structured products, stay away. Keep it simple. Stay with an active ETF that's transparent, that's selling covered calls. And back to the ETFs, I like the ETFs even more for this because, a sector typically is never going to go to zero, right? Let's be honest. But stocks can go to zero, right? If you sold covered calls in Enron, that didn't really help you. So we are selling, in our case, we're selling covered calls on indexes or ETFs, sector ETFs, which I think is something that you should be, on the lookout for as well if you're looking into this space.
Yeah, cool. All right, so this really concludes the first part of our podcast, the wise investing part, and we really wanted to ask about it because this particular space, alternative incomes, hedge equity, is by far the hottest space in the kind of the ETF industry this year. So we wanted to really hit on that. But let's move to stronger living. And Darol, you have a reputation for being extremely high energy. You seem to be everywhere at once. So how do you manage your time and energy to perform at such a high level?
Yes, thank you for saying that. I do have a lot of energy. I work really, really hard. I mean, much of that's taking those distractions, like we mentioned earlier, out. Focus on what's important for you. I'm high energy. I feel like I'm like a border collie sometimes. I love to work. My parents gave me the gift of work ethic, the spirit of capitalism and self-reliance. I hope I can pass that along to my son one day. But I do take a few weeks every year to travel. I love traveling to cool places. I was just in Ireland, and I know you were as well, right before me. I'm a total foodie, and that travel lets me recharge my batteries. I love to get away, but not for too long. And I'm going to give you a great quote. Shakespeare said, "Leisure is a beautiful garment for a day, but a horrible choice for permanent attire." So basically what he's saying is, you got to go away and enjoy some leisure, but you don't want to be there the whole time. It's probably why I just don't see myself ever retiring. I just enjoy what I do. I love working. I love the challenge of it. Obviously, you've got to get away, but I enjoy it.
All right. Well, we've talked about how you recharge, but how do you stay grounded? What are some day-to-day routines that you have?
Yep. I love hiking. As I've been on a hike with Rusty before, he knows I love hiking. 15 minutes away, I'm here in San Francisco, and 15 minutes from here, you've got some of the best hiking trails probably in the country. So love to do that. I love spending time in the ocean. I probably do my best thinking in the jacuzzi. I sit there, look at the view, and zone out, and that's where I really can get grounded. But I also stay grounded with my son, right? He's like the light of my life. He keeps me focused on on the real important things.
We brought this up a couple times on the podcast because it came from our very first guest, Dr. Dana Crosby, that if the importance of the children in terms of the values, if you just had a picture of your child or children before you made a financial decision, it just aligns the values. It's really remarkable advice.
So
I think
true.
I brought it up on every other podcast.
So true. I've got 3 pictures in my office right now.
Awesome. Well, Robin and I love to ask this type of question, and this time she let me ask it, so this is great. So if you could leave listeners with just one piece of wisdom on investing well and stronger living, what would it be?
Surround yourself with other people that can help you do things, right? Obviously, in this case, it would be a financial advisor, but, whether it's, financially an advisor or a good CPA, or whether it's your health, a good trainer, a good doctor, surround yourself with the right people. And don't stop believing. Believe in yourself, believe in your family, investing, and that's pretty much it. I think that's all the advice I can give you, Rusty.
I love it.
Yep. Great. Circle back to end the show. Darol, thanks so much for coming on. It's been so great to chat with you. Before we let you go, tell us, how can our listeners stay in touch and learn more about what you're doing?
Come out and see us. I mean, we've got a lot of clients. We just had 15 clients out here yesterday. We're having our big conference, or we'll come see you. I like getting face-to-face with people. Let's sit down and break bread and have dinner. Obviously, Main, MAIN, You can find us there. We're all over LinkedIn, etc. But love to see people face-to-face. We've got a great office here in San Francisco, and the door is always open.
Well, Darol, awesome. And I can confirm those hiking trails outside of San Francisco are absolutely beautiful, really stunning hikes. And you are a foodie, and living in San Francisco, I've been able to break bread with you a few times, and that is a great city to do it. I look forward to more meals with you.
Same here. Thank you very much. Thank you, Robin.
Yep. Thank you. We'll be back next week. Thanks for listening to Invest Well, Be Well. Let us know what you think. And if you like what you hear, don't forget to subscribe. This podcast is hosted by Rusty Vanneman and Robin Murray and produced by Garrett Crosby. Well, we'll be back next week. Thanks for listening to Invest Well, Be Well. And hey, if you like this episode, don't forget to subscribe.
If you have feedback, guest suggestions, or just want to connect, please visit my website, rustysbridge.com, or email me directly at rusty@rustysbridge.com. Until next time, invest well and be well.